Let's take a closer look now at the Kenyan markets picture. Yesterday, we had the NSE 20 share index rising for a 10th session, up 0.5% to 4,633.5 points there, a level that was last touched on November the 9th, 2010. This now taking that main index up 12% so far this year. The rally mainly driven by investors buying stocks, especially from banks ahead of the release of full year earnings, which they expect to be strong due to falling interest rates and lower inflation readings that came through last year. We'll be putting the spotlight on those Barclays Bank numbers in just a bit. Before we do, Kenya Commercial Bank, which is the country's biggest bank by assets, led the gains in yesterday's session for a third straight time, adding 4.1% to close at 38 shillings 25 a share. It hit a new record high of 39 shillings during the session, and traders saying that they expect the bank to post a minimum earnings per share of 5.5 shillings for the full year 2012 when it unveils results on February the 27th. That's up from 4 shillings 21 in the first 9 months of the year. On the currency front, with the shilling receiving some support from foreign investors who are buying into Kenyan shares, we had the shilling firming against the dollar yesterday, also helped by the central bank's squeeze on liquidity in the market. We've got the local unit coming into this morning pretty flat at 87.40 right now, with traders saying that it looks like the shilling will have some strength with interest rates going up. This where the local currency has been under pressure this year from importers buying dollars ahead of the presidential election on March the 4th. It's down 1.4% against the dollar year to date. So that a broad look at the market scene over on that end. Let's get into some analysis now with Rufus Mwanyasi. He's an investment analyst over at Tsavo Securities. Thanks so much, Rufus, for joining us this morning. Well, as I was saying earlier, the market hitting a 27-month high yesterday. The bulls seem to be out in full force. What are you making of the current valuations we're seeing on the market right now?
Yeah, that is true. The market is really on an up and up, and chiefly the reason why the market is going up is we're seeing new investors coming into the market. As you correctly say, that once the market zoomed past the 3-year high last touched in 2010 October, we've seen new interest. Actually, guys who've been sitting on the sidelines since the year began, and so once this resistance line, if I may put it that way, was crossed, we've seen a new rush of buyers coming into the market, and I guess that's the reason why we're seeing the market moving up.
Well, let's take a look at another reason, because of course we've had the expectations of good earnings reports coming through from our banks, providing a lot of the encouragement for investors to start delving in. And on that note, we've seen Barclays Bank out with numbers this morning. We touched on those numbers a little earlier. Tax profit rising 8%. We've had income rising 4% and a total dividend up 11%. What do you make of those headline numbers that have filtered through today? Have they met your expectations?
Yes. First of all, I'd like to say that on the profit side, it's a little bit below expectation. We're expecting a number about 10%. That's a figure of about $45 million, but it came around $36 million. Our expectations were, based on the fact that the whole banking industry as a whole kept an interest rate of about 37 charged on customers. So we expected a little bit higher. But of course, I must say that I'm impressed, with the income and with the cost only up by about only 5%, which tells you that the bank is really doing a lot in terms of keeping its costs down. And in fact, for this year, they've already announced that they could be shedding off, roughly about 5,000 jobs. And I think going forward, this is going to, really, protect its margins. But I think from an investor point of view, we'd want to see more and more growth on the revenue side. And I think, as we enter into the earnings seasons, I think we're going to see more banks even, do maybe, double-digit revenue, growth, more better than even Barclays Bank.
Well, as you've highlighted, that cost-to-income ratio has certainly stood out this morning. That's sitting stable at 52% in the 2012 period. But as you highlighted, a lot of pressure on this bank now to start increasing its revenue. Rufus, you've highlighted the fact that if it's maintained interest rates pretty high at 37%, there's been a lot of pressure on Kenyan banks, though, by the Central Bank of Kenya to actually lower those interest rates in tandem with what the central bank itself has been doing. So what's your outlook in terms of their interest rate, going forward, and what they're able to actually charge customers down the line?
Well, I expect maybe a revision downwards of the general interest rate, bearing in mind that inflation has really stayed below 4%, and now we're entering at the third month. Inflation rate coming below 5%, which is the target by the central bank. I think if the same scenario holds for the next 6 months, I think the banking sector will have no reason but to bring the rates downwards. But however, we also like to look at this thing in a more broader perspective in terms of the other risks that also inform the compilation of that rate. We're talking of political risk, and as you well know that we're in an electioneering year, and I think these are some of the factors that the bank is considering, and not just the inflation risk. But going forward, I think just looking at the macro environment, things are very stable, and I think the political risk is not really a factor. In my view, and when you look at other risks in terms of the currency and others, I think they've been stable at least for the last 6 months. So I guess going forward, yes, we may see a reduction downwards of the rate, and I think this will also even be a benefit to the industry in terms of getting more loans out there and even increasing their top line.
Well, let's take a look at the risk of impairments, because we've had bad debts falling here to 3.8 billion shillings during the year from 5.5 billion shillings. So it seems like the bank is slowly starting to get a handle on things there. What do you make of the kind of stride the bank is making in mitigating against the risk of impairments?
First of all, I think despite having seen banks last year, being aggressive in terms of expanding their loan book, the banks have been very conservative when you look at it more keenly in terms of who they're lending and out there. And in fact, what we've seen is and what we expect actually for this year, we expect a slight increase of their loan book and about 16%, which is which will be slightly lower than the previous year, 2011. And I think this tells you that the banks in the industry itself has been very conservative in terms of who they're lending out there, and I think this will also help them in terms of keeping their the books in order. But even having said that, we've seen their non-performing loans increasing about 14% in the period of 2011, and I expect the same to happen this year. So I guess the banks have a lot to do in terms of just containing their risks, and I think it'll be very interesting to watch how what really turns out for this particular year.
Rufus, you highlighted at the top that we've had Barclays Bank missing your expectations. You were expecting pre-tax profit rising 10%. It's come in 8% higher. Yes. I was looking at KCB at the top of the show, and there are great expectations around KCB as well. Expectations of a minimum earnings per share of 5 shillings 50, and that up from 4 shillings 21 in the first 9 months of the year. What do you make of where that expectation bar is being set right now?
I think when you look at the top 5 banks in the country, KCB is actually one of the the leader of the pack in my view in terms of being aggressive and lending out there. And also another factor is considering they are spread all over the region, and lately we've seen a great or should I say, a great chunk of their revenues coming actually from their subsidiaries in the region. So I guess this is what really feeding, that kind of expectation from the analysts that we expect, growth, in the revenue all the way down to to the bottom line. We expect growth across the board, particularly supported by really good performance from the subsidiaries, but also even locally they're doing quite well. I expect to have a growth in I expect to see actually growth in their profits in the region of about 15 to 20%. And in my view, I think that's one of the banks to look at as we enter into the earnings seasons.
We've had that share price hitting a high of 39 shillings during the session yesterday. Would you be a buyer at this price point, or is there more value to be found elsewhere in the sector?
Well, I think, in my view, maybe just to answer the question from a technical perspective, I think by the time it crossed 35, in my view, the price was already overstretched. Because for the last 5 years, 35 has always been, you know, the resistance line. So once it crossed that line, yes, of course, it showed, you know, really a strong momentum. But in my view, I think the price is already overstretched. I expect a little bit pullback maybe in the next 3 months. But in terms of fundamentally and just looking at it from a long-term perspective, it is a buy for us. But just to say, in terms of timing, I think it's a wait and see until maybe we see a pullback of about 5 to 10% from the current price right now before we actually do a recommendation for a buy.